everyone, and thank you for joining us for Bank Talk. This is Ethan Heisler and my boss and mentor, Van Hesser.
Welcome, Ethan.
Van, we were talking about bank earnings in the last newsletter. What did you think about some of the comments that I was writing about?
Well, I thought it was interesting, Ethan. I mean, if we think about bank earnings, the big swing factor remains relatively, in fact, entirely benign. That is the loan loss provision number, and that speaks to everything going on in the economy. Maybe we can follow up on that later. But what I thought was interesting, this especially being Fed Day, where we expect the Fed to hike rates later this afternoon. I did notice comments in your newsletter about this interesting relationship between 1-month LIBOR widening out to Fed funds. Now, that sounds like a very technical point to me, but you thought it helped margins for the banks in the first half, and I wondered if you are thinking that is still going to play positively in what we expect for third quarter earnings.
Right. Well, Van, I think it's always interesting as analysts, we always talk about asset sensitivity, and when the Fed's raising interest rates, our concerns always go towards this idea, is our banks being asset sensitive here? Are they going to benefit? If you're asset sensitive, means your assets reprice faster than your liabilities. So if the Fed's raising rates, that widens margins, it improves earnings, that's all good. But what I think as analysts we don't pay too close attention to is, what does asset sensitivity actually mean? So, hey, we're asset sensitive. Are you asset sensitive at 1 year? Are you asset sensitive at 3 months? But what's notable is when we talk about banks, particularly commercial banks, the kind of commercial bank loans that they're making are principally tied to 1-month LIBOR. So if you think about where is asset sensitivity most important, it's not 2 years, it's not even 3 months, it's actually really close to 1 month. And so what we saw in the first half of the year, which was very interesting, is that 1-month LIBOR widened by about 20 basis points. And I know that sounds like a really small number, but it widened by 20 basis points from basically 10 basis points, okay? So it really widened out. And that benefited net interest margins for virtually every single institution. All banks were reporting stronger margins in the first half. But the street is very axed in the third quarter now to think that this is going to continue. And what came out is, if you look at 1-month LIBOR to now, and again, you said it was technical. It is technical. But 1-month LIBOR to Fed funds has retraced half of that spread widening.
Which is a way of saying that you think that all other things being equal, at benefit that the market might be expecting in a rising rate environment is going to be more muted in third quarter earnings statements.
That's right. And it's coupled with the other point, which is an expectation among many analysts today on the liability side that there's going to be some big repricing or an inflection in deposit betas. Right. And again, I know from a corporate credit perspective, it's sort of like, yeah, it's very interesting, but as you just said before, it was provisions. But I think we shouldn't ignore the fact that earnings and strong earnings and consistency through earnings is an important element within credit safety.
Right, I agree with all of that. And as I always thought through this boost to earnings that the market was expecting related to a rising rate environment, the long-awaited rising rate environment, was going to be fairly muted anyway, because this whole idea of dynamic hedging, right? If you have limited visibility, which has been pretty much the case going back 10 years, we've been obviously in economic expansion, but I don't think at any point along that trail did anybody feel like we've got great line of sight into what the future holds. And if that's the case, this idea that you're going to dynamically hedge your balance sheet, to me, suggests that bank managers were going to take a little bit away of that frothiness that might happen in the rate rise in the interest of preparing for any eventual outcome.
Well, look, Van, I got to tell you, I really personally think that third quarter earnings are going to be a little bit more disappointing than people think. And I think a couple of reasons. One, I said, is this LIBOR reversal, which I think is important. Another one, I think, is just the fact that loan demand is just not there. I mean, another very consistent comment in the third quarter. And they had the Barclays conference earlier this month, and it was really interesting to hear comments there. As virtually every bank came in and said, you know what, this tax reform stuff, this did not spur loan growth. Quite the opposite. Banks are finding their corporate customers are taking the extra cash flow from their balance sheets and using that to, instead of borrowing money, or they're going through the debt capital markets, but they're not going into bank loans. So if you think about it, you've got deposit loan betas that are probably not working in your favor in the third quarter, which they were in the first half of the year. You've got a loan demand that's less than exciting, and then the other big concern is deposit repricing betas. Now, everybody I talk to believes that the industry is about to go through some inflection point. You hear this from every CFO in the Barclays conference. You heard it in the second quarter earnings. Everyone's saying that the depositors are waking up, they're starting to demand. But what I keep coming back to, and one of the comments I heard this month from a treasurer said, you know what? Actually, it's that the examiners are coming in and telling these banks, you know what, you need more retail deposits, so go out and bid them. But wait a minute. My loan deposit ratio is 70%. I'm going to take that extra money. I have to put it in the bond portfolio. The best yield I can offer, the best rate I can offer for deposit is pretty much what I can get paid in the bond book, which ain't very much. So I think that, I think there's going to be a little bit more disappointment as we come into third quarter earnings, and that's probably what I'm saying. The only other thing I would just say, and I know that you tend to roll your eyes with me when I talk about this, but I do think that there is some significant potential event risk in the bank space with respect to this LIBOR. And one of the other things I wrote about in the newsletter that I thought was interesting is if you look at the number of bids for LIBOR being submitted in 1 month LIBOR space, it's fallen by half in the first half of this year. So you're basically down to 5 bids. 5 bids. Now, if you would take an average of 5 and base all the contracts that you have based on those 5 rates, how likely do you think at some point you might get sued for relying on something as unreliable and shaky as that? Well, that's what's coming.
And here's, you're right about my rolling the eyes, only because this reeks a little bit of Y2K to me. However, I would say if it is truly as you expect, and granted some of that anecdotal evidence that's out there suggests that there could be an issue when all of this sort of takes place, where are the regulators on this, right? This is something that your tax dollars should be at work trying to mitigate the impact of this. Is there any sign that this has hit the regulators' radar?
Oh, absolutely. Well, first of all, this LIBOR is supposed to go extinct at the end of 2021. What I raised was the concern that the European Union could wake up one morning, you could come into work, and you could see across your screen, oh, by the way, the European Union said that the 1 month LIBOR is no longer a reliable benchmark. That is an event risk. Now, the possibilities of that, it could happen. It could if this continues to go there. Where are regulators in that? Regulators have been sounding the alarms. Regulators have been encouraging institutions to start working on SOFR. And we just saw a major deal. World Bank did a $1 billion 2-year deal in SOFR space. We've seen Barclays come into it. We've had other institutions, and we will see more of that. But we're still in the early stages of this transition, but these are warning clouds out there that people need to be more aware of. And I think investors need to be thinking about this and certainly asking the questions of banks when they see them in their meetings. Hey, what is the plan for LIBOR?
Yep, I think that's probably sound advice. Let's leave it at that. Thanks again for joining us today, and we'll see you at the next Bank Talk.
Thanks, Fan.